Hey everyone, welcome to MoneyDhan, where we simplify the world of money, investing, and financial planning for you. Today, we are diving into something powerful 11 thumb rule that can change the way you think about saving, growing, and managing your money. Now, why thumb rules? Because they are simple, practical, and based on real world experience. And when it comes to personal finance, these rules can be your secret weapon to making better decisions. In this video, I am going to break down each rule so you can apply them right away. And trust me, the first one is a game changer. The rule of 72. Let's get started. The rule of 72. The rule of 72 is one of the most straightforward yet powerful tool in finance. It helps you figure out how long it will take for your money to double at a fixed rate of return. Here how it works. Take the number 72 and divide it by the annual return percentage of your investment. The result is the number of years it will take for your money to double. Here how it works. For example, let's say you invest in a fixed deposit offering a 6% annual return. Divide 72 by 6 and the answer is 12 years. That's how long it will take for your money to double. Now let's flip the rule. What if you want your money to double in 5 years? Easy. Divide 72 by 5 and you get 14.4%. That's the annual return you will need to achieve your goal. This simple calculation can help you make better decisions about where to invest your hard earned money, whether it's fixed deposit, mutual funds, or the stock market. This rule is a must know for every investor. And that's just the first of 11 thumb rules we are covering today. Ready for the next one? Let's keep going. The rule of 114. Now that we have covered the rule of 72, let's take it up a notch with the rule of 114. If the rule of 72 tells you how long it will take to double your money, the rule of 114 tells you how long it will take to triple your money. Here's how it works. Take the number 114 and divide it by the annual return percentage of your investment. The result is the number of years it will take for your money to triple. For example, say you invest rupees 1 lakh in a product that delivers a 12% annual return. Divide 114 by 12 and the answer is roughly 9.5 years. So, in about 10 years, your 1 lakh will grow to 3 lakh. But here's where things get exciting. Let's extend this idea further. If 1 lakh becomes 3 lakh in 10 years, then in another 10 years, that 3 lakh becomes 9 lakh. And in 30 years, 1 lakh turns into 27 lakh. By 40 years, it grows to 81 lakh. Now imagine this. If you gift your child 10 lakh rupees on their 20th birthday and invest it in an instrument that earns 12% annual returns for 40 years, you are essentially gifting them a 10 crore retirement fund. Think about it. A simple investment and a little patience can create massive wealth over time. And that's the power of computing combined with the rule of 114. Ready for the next thumb rule? Let's keep it rolling. The rule of 70. Alright, let's talk about something most people overlook when planning their finances. Inflation. You might think rupees 50 lakhs is a lot of money today, but have you ever wondered what it will be worth in the future? That's where the rule of 70 comes in. The rule of 70 helps you estimate how long it will take for your money's purchasing power to have due to inflation. Here how it works. Take the number 70 and divide it by the expected long-term inflation rate. The result is the number of years it will take for your money's value to be cut in half. For example, let's say you have saved up to 50 lakh rupees and the average inflation rate in India is estimated at 5%. Divide 70 by 5 and you get 14 years. This means that in 14 years, the real value of your 50 lakhs will drop to 25 lakhs. Think about it. The same 15 lakh that feels significant today will only have half its purchasing power in just over a decade. And here's why this rule matters. If you are not investing your money in the ways that beat inflation, you are actually losing wealth over time. Inflation isn't just a number, it's a silent killer of purchasing power. So, while 50 lakhs becomes 25 lakhs in 14 years, smart investing can ensure that your wealth grows faster than inflation. That's the key takeaway from the rule of 70. Let's move on to the next thumb rule. It's just as important. The 10-5-3 rule. When it comes to investing, one of the most important questions is what returns can I expect? And that's where the 10-5-3 rule comes in. A simple, practical framework to guide your long-term investment decisions. Here how it works. 10% returns annually from equities like stock markets or mutual funds. 5% returns annually from debt instruments like bond or fixed deposit. 3% returns annually from your savings bank account. This rule gives you a baseline expectation for returns across different investment options. But let me clear, these numbers aren't guaranteed. They are a conservation benchmark based on historical trends. For example, if you are investing in the stock market, you might aim for 10% annual growth over the long term, factoring in market ups and downs. Debt instruments like fixed deposit or bonds typically deliver steady but lower returns, around 5%. And your savings account at 3% or so, it's not where you want to park money for growth, it's just for liquidity. Now, why is the 10-5-3 rule useful? Because it gives a workable starting point to set realistic expectations for your investment. It's not about chasing the highest returns, it's about having a balanced, well thought out strategy. So, the next time you are planning your investments, keep this rule in mind. Use it to evaluate where to put your money and how much to allocate based on your goals and risk tolerance. Let's move to the next thumb rule. It's another game changer. The 100 minus age rule. Let's talk about one of the simplest and most effective thumb rules for investing. The 100 minus age rule. If you have ever wondered how much of your money should go into equities versus debt, this rule gives you a quick and easy answer. Here how it works. Subtract your age from 100. The resulting number is the percentage of your wealth and that should be allocated to equities. The rest, that goes into debit instrument for stability. Let's break it down with an example. If you are 30 years old, subtract 30 from 100. The result is 70. That means 70% of your portfolio should be in equities and the remaining 30% in debt. Why does this rule work? Because as you age, your ability to take risk generally decreases. Equities, while high growth, are also high risk. On the other hand, debt offers stability and lower risk, which becomes more important as you get closer to retirement. Now, does this rule have its limitations? Absolutely. It doesn't factor in things like your specific financial goals, your personal risk tolerance, the stage of life you are in. But here's the key. If you are starting out and feeling clueless about asset allocation, the 100 minus age rule is a great place to begin. It's simple, practical, and better than having no strategy at all. So, what's your age? Subtract it from 100 and start building your portfolio today. And if you want a deeper dive into the asset allocation strategies, check out more of our videos. Alright, let's move on to the next thumb rule. You don't want to miss this one. The 4% withdrawal rule. Let's talk about one of the most popular thumb rules for retirement planning, the 4% withdrawal rule. If you are ever wondered how to make your retirement savings last, this rule gives you a starting point for managing your withdrawals. Here how it works. Take your total retirement corpus, let's call it X, and withdraw 4% of that amount every year. This ensures that in most scenarios, you won't run out of money during your lifetime. For example, say you have built a retirement fund of rupees 1 crore. According to this rule, you should withdraw no more than rupees 4 lakh per year or about rupees 33,000 per month. By sticking to this limit, your corpus is likely to last through your retirement years. But here's the catch. This rule was created back in 1994 in the US, where inflation and treasury yields were much higher than they are today. And when you apply it to a developing country like India, the dynamics change significantly. In today's environment, inflation rates, lower returns, and rising life expectancy means the 4% rule might not work as well. It's a great starting point, but you may need to adjust it based on your unique situation. What's your retirement lifestyle? What are your inflation assumptions? What returns are you realistically expecting? So, while the 4% rule gives you a framework, you will need a more customized strategy to navigate retirement planning in India. And here's the fun part. If you have come across any updated version of this rule or unique ways to apply it, let us know in the comments. We are allowed to hear our thoughts. Alright, let's move on to the next thumb rule. It's another one you don't want to miss. The 50-30-20 rule. The 50-30-20 rule is one of the most widely used thumb rules for budgeting. It gives you a simple formula to divide your income into 3 buckets. First one, 50% for living expenses. This covers essentials like rent, groceries, electricity, and day-to-day needs. Second, 30% for discretionary expenses. Think of this as your fund money, dining out, movies, gym membership, gifts, etc. 20% for savings and investments. This is the most crucial part, money that goes towards building wealth, creating a financial cushion, or achieving long-term goals. Now here's the key. This ratio isn't set in stone. If you can save more than 20%, go for it. The rule is meant to give you a starting point for better money management. Depending on your income, life stage, or financial priorities, you can tweak this ratio to suit your needs. For example, if you are in your 20s, you might focus on saving aggressively for future goals. If you are in your 40s with kids, you may need to allocate more towards essentials. The 50-30-20 rule isn't about restriction, it's about clarity. Once you know where your money is going, you can take control and make smarter financial decisions. The 3x emergency fund rule. Now let's talk about financial safety nets. The 3x emergency fund rule is all about preparing for life's unexpected moments, such as job loss, medical emergencies, urgent travel, or home repair, etc. Here how it works. Keep 3 times your monthly income in a dedicated emergency fund. If you want more security, aim for 6 months worth of expenses instead. For example, if your monthly income is 50,000 rupees, you should have at least 1.5 lakhs in an emergency fund. This ensures you can handle unexpected expenses without disrupting your long-term investments or lifestyle. Now, where should you park this money? Your emergency funds need to be liquid and accessible. Options like liquid funds or saving accounts are great. The bottom line, life happens and an emergency fund keeps you financially stable when it does. So start building yours today. Budgeting help you take control and an emergency fund gives you peace of mind. Use these rules as your foundation. Adapt them to your unique situation and watch your financial confidence grow. The weak spending rule. Let's talk about one of the biggest trap in today's world, impulse spending. Think about it. You are scrolling to Amazon and the site hits you with a suggestion like customers who bought this also bought. Sounds helpful, right? But here's the truth. It's not doing you a favor. It is designed to make you spend more. From pricing and packaging to category placement and promotion, everything is manipulated to get you to buy things you don't really need. That's why you need the 1 week spending rule, a simple but powerful tool to protect yourself from impulsive purchases. Here how it works. If something shiny or new catches your eye and you feel tempted to buy it, stop. Wait for 1 full week before making the purchase. During this time, ask yourself a few key questions. How useful is this purchase? What's the real return or investment? How have I been living without this product as so far? Could this money be used for something more important? If after a week you still feel strongly about the purchase, then go ahead and buy it. But chances are that 1 week gap will give you the clarity you need to realize it's not worth it. Why does this rule work? Because it builds a barrier between seeing and buying. It forces you to think logically instead of emotionally. And let's be real, most impulse purchases don't make you happier in the long run. They just drain your wallet. Start purchasing the 1 week spending rule religiously, and you will notice a massive drop in wasteful expenses. The money you save can be redirected towards things that truly matter, your investment, your goals, and your dreams. Alright, let's move on to the next thumb rule. It's just an impactful. Let's talk about debt because while loans can help you achieve big goals, they can also become a financial burden if you are not careful. That's where the 40% EMI rule comes in. It's a simple guideline to ensure you are borrowing responsibly and staying in control of your finances. Here how it works. Your total EMIs, including home loan, car loan, or any other debt, should not exceed 40% of your monthly take-home income. For example, let's say your monthly salary after taxes is 50,000 rupees. According to the rule, your combined EMIs should be 20,000 rupees or less. Why does this rule matter? Because once your EMIs crosses the 40% mark, it puts significant pressure on expenses, say for future goals or deal with emergencies. And let's be real, living paycheck to paycheck because of high EMIs isn't a situation you want to be in. Now here's the thing. No one is stopping you from exceeding this limit. You can choose to go beyond 40%. But ask yourself this first. Can you still comfortably handle your monthly expenses? Are you saving enough for emergencies or long-term goals? Is this loan worth the added financial stress? The 40% EMI rule isn't just about limiting your debt. It's about maintaining financial stability and giving yourself breathing room. So, the next time you are considering a loan, calculate your EMIs, check your income, and make sure you stay within that 40% limit. Debt can be a powerful tool, but only if you see it wisely. Stick this rule and you will stay on the path to financial freedom. Let's move on to the next thumb rule, the 20x life cover rule. Let's talk about something most people overlook until it's too late, life insurance. If you are earning and have financial dependence, having the right life cover isn't just important, it's non negotiable. So, how much life insurance do you actually need? That's where the 20x life cover rules comes in. Here how it works. Your life insurance cover should be at least 20 times your annual income. For example, if you earn rupees 10 lakh a year, your life cover should be 2 crore. Some insurance providers may offer 15x coverage, but if you are in your 20s or 30s, aim for 20x. Why? Because it ensures that in case of any unexpected events, your family remains financially secure. Think of it this way: your life insurance isn't for you, it's for the people who depend on you. It's about protecting your spouse, kids, or parents from financial struggles if something happens to you. It's not an expense, it's a shield for your family's future. And if you don't have life insurance yet or feel you are underinsured, now is the time to fix that. And with that, we wrap up today's video. We have covered some of the most powerful thumb rules that can help you save, invest, and protect your financial future. Knowledge is power, but applied knowledge is financial freedom. If you found this video valuable, hit that like button, subscribe to the channel, and share this video with your friends on WhatsApp, Facebook, and Twitter. The more people who know these rules, the better financial decision they will make. And remember, invest smart, stay protected, and take charge of your financial future. I will see you next week with another game changing video. Until then, stay wise, stay invested.